If you've been watching the dry bulk shipping space, Safe Bulkers just dropped their Q1 2026 earnings, and there's a lot packed inside. From a massive EPS jump to a historic stock exchange listing, this company is making some serious moves. Stick around because we're counting down the top 10 takeaways you need to know, starting at number 10. Coming in at number 10, Safe Bulkers made history by becoming the first shipping company to have its common stock traded on both the New York Stock Exchange and Euronext Athens. That Euronext listing unlocks access to 8 European stock exchanges, including Paris, Milan, Oslo, and Amsterdam, broadening the company's investor base well beyond its traditional U.S. audience. At number 9, the board declared an increased dividend of 6 cents per common share. That's the 18th consecutive quarterly dividend, representing a 3.7% annualized yield at current share prices, a signal of consistent shareholder commitment even as the company funds an aggressive fleet renewal program. Number 8 is all about earnings momentum. EPS surged to 18 cents in Q1 2026 versus just 5 cents in the same quarter last year, a 260% increase year over year. That kind of growth is hard to ignore, and it's being driven by higher charter rates and improved scrubber earnings. At number 7, Safe Bulkers is actively reshaping its fleet for the future. The company placed orders for 6 new Phase 3 new builds and sold its oldest Kamsarmax and Post-Panamax vessels. By 2029, management expects 45% of the fleet to be Phase 3, positioning them as a fuel efficiency leader as regulations tighten after 2030. Number 6 is the balance sheet story. The company holds approximately $374 million in liquidity and capital resources, carries a conservative leverage ratio of just 34%, and has $161 million in contracted revenue backlog. That's more than double their outstanding capital expenditure, giving management real flexibility to grow or return capital. Halfway through at number 5, the macro setup looks favorable. In an open Strait of Hormuz scenario, dry bulk demand is forecast to grow 3% in 2026, while supply grows only 2%. Grains are the standout commodity, projected to grow 5%, while iron ore and minor bulks also support positive demand dynamics. Number 4 is a geopolitical wildcard that's turning into a tailwind. Iranian attacks knocked out roughly 17% of Qatar's LNG export capacity, and that's redirecting energy demand towards steam coal, particularly from Australia and Indonesia. CEO Polly's Hagioanu confirmed cargo volumes in the Pacific have surged, pushing rates on the BKI index to around $20,000 to $22,000 per day. At number 3, Safe Bulkers Capesize fleet is locked in and earning well. All 7 Capesize vessels are on period time charters with an average remaining duration of 1.7 years and an average daily hire of $24,600. That translates to over $110 million in contracted Capesize revenue alone, a very visible and stable cash flow stream. Number 2 highlights the operational and financial performance improvement across the board. Adjusted EBITDA climbed to $40.7 million from $29.4 million a year ago, and the average time charter equivalent rate rose to $17,095 from $14,655. Meanwhile, daily vessel operating expenses actually dropped 9%, showing disciplined cost control running alongside revenue growth. And the number 1 takeaway, the potential upside from Iran's reconstruction. Management highlighted that a post-conflict recovery in Iran could unleash a surge of fertilizer cargoes that have been bottled up in the Persian Gulf for months, while also boosting demand for Handysize and Ultramax vessels. That ripple effect supports the entire freight market, including Safe Bulkers' core Kamsarmax segment. If sanctions ease and foreign flag vessels get access to Iranian trade, this could be a meaningful multi-quarter catalyst. That wraps up the top 10 takeaways from Safe Bulkers' Q1 2026 earnings call. Strong earnings growth, a historic dual listing, fleet renewal, and some compelling geopolitical tailwinds. There's a lot for investors to watch here. If you found this useful, hit that like button and subscribe for more shipping sector breakdowns.